Ladies and gentlemen, good day and welcome to Carysil Limited Q4 and FY24 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantee of future performance and involve risks and uncertainty that are difficult to predict. As a reminder, all participants' line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chirag Parekh, Chairman and Managing Director of Carysil Limited. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. Thank you for joining us for Carysil Limited Q4 and FY24 earnings conference call. I trust you had an opportunity to review our financial results and investor presentation, both available on the company's website and on stock exchanges. Joining me on this call is Mr. Anand Sharma, our Executive Director and Group CFO, and SGA, our Investor Relations Advisors. Despite geopolitical uncertainty, global economies have experienced a recovery in economic activities in FY24, with inflation remaining elevated yet stable. While Europe has contended with its own unique challenges, the resilience of the U.S. economy has provided support to global markets. India continues to be the world's fastest growing major economy thanks to a stable government, pro-business policies, substantial infrastructure development, and an emphasis on boosting domestic manufacturing. And aesthetics of everyday life increase the joy of living, improve the quality of life, and contribute zeal to the daily routine. When combined with the purpose and excellence, the power of everyday aesthetics elevates the product into unbeatable value proposition. During this concept, Carysil is rapidly heading towards a higher growth trajectory. We are becoming a preferred brand for high-end consumers for providing the market with a contemporary and sophisticated premium collection of well-designed kitchen products and accessories. India has an enormous youth population that is evolving buying habits, aspiration, and aesthetic sense. The demand for quality, visually appealing kitchen products and the combined luxury utility have high offtake. This trend offers a significant opportunity for Carysil because we have the mindset, skill, and capability to capitalize on increasing awareness among potential buyers. Built-in kitchen appliances is one of the growing product area in India. Growing consumer spending on luxurious products and premium products, the growing working women population, and increased development of premium apartments together with an increasing number of distributors and expanded retail format will propel growth in this segment. Due to the rising popularity of undermount sinks worldwide, inclination towards natural stone-based products, significant overseas markets are transitioning towards granite sinks. Carysil is better positioned to capitalize on the trend started in Europe, UK, United States, and spreading over to Asia and other down under countries with its kitchen appliances, sinks, or kitchen surfaces. Our US, Europe, UK regions continue to perform well, except Germany, which continues to remain subpar in terms of demand. When it comes to regional growth, the United States is more organic, whereas within the United Kingdom, we have more focused on new customer acquisitions. As said so, where we see issues have caused a bit delay in transit and availability of containers and increase in high freight costs during the last quarter. We continue to remain optimistic on opportunities that exist in domestic market. To enhance the share of business in domestic market, have a more focused approach. We are increasing our bandwidth, building leadership team around the key business segment. We have appointed Ms. Nikila Sridhar, a B2B business head, Pan India, and Mr. Rajesh Nair as President Sales of Stern Iron Division, Pan India. Our GCC business has started on a very positive note and showing lots of potential in coming years. This is already a profitable business in terms of EBITDA. Our efforts are on further accelerate the growth in the Gulf region. We are focusing to increase our business in UAE, Oman, Qatar, and Saudi Arabia. We are developing more markets like in Turkey, Australia, Vietnam, Indonesia, Croatia, etc. I have some good news. We have signed the contract with Reis Australia Pty Limited, which is one of the big retail chains having more than $100 million sales, the country's largest supplier of plumbing and bathroom supplies. This contract come into effective as we have received official orders from Reis Australia. We are pleased to announce we have begun commercial production of the appliances and the faucets. We have started about 3 models of chimneys and around 10 SKUs of faucets, slowly expand to more models, reduce import dependence. We will gradually increase capacity utilization model based on segment response and growth. Coming to our acquired entity, Carysil Services Limited UK continues to perform better in spite of challenging economic conditions. We have increased our product portfolio and distribution capabilities to service both home and commercial customers in the UK market. This has strengthened our position in the UK solid surface sector. We also signed recently a major deal with one of the largest retail chain of stores, home-based, in UK. Carysil Products Limited continue to perform, which is mostly distribution of sinks and faucets, continue to perform in spite of challenging economic conditions in UK market. We are now also started exporting most of their stainless steel kitchen sink requirement from India, which will further improve their profitability. Our first acquisition in the United States, United Granite LLC, a fabrication company, showing improved business performance mostly in the last previous months, especially in the month of April, and we continue to grow in the coming quarters. Improvement in residential sales, which is a high margin sales, is improving. There are few initiatives which company is planning to undertake. Phase 1, we're planning to launch sinks and faucet distribution under the Stern brand in the DC, Virginia, and Maryland area. We're also planning to launch high-end margin exotic stone tops, which will fetch better gross margins. Third, we are planning to open a 4th showroom in the DMV area to maximize sales. In the phase 2, we plan to launch the built-in appliances under the Stern brand, which will be a one-stop model solution just like India. This kind of model is getting very popular, not in the US but also in UK. We are confident that these changes will contribute to long-term stability and profitability to the company. I would like to ask Mr. Anand Sharma our update on the company's financial performance. Thank you. Over to you, Anand.
Thank you, sir. Good afternoon, everyone. Let me take you through the company consolidated financial performance, Q4 FY performance. Consolidated total income stood at 192.1 crore for Q4 FY24, which is grew by 31.9% year-on-year basis. EBITDA for Q4 FY24 stood at 36.2 crore, grew by 36.4% YoY. EBITDA margin for Q4 FY24 stood at 18.8%. This is impacted due to integration effects of United Granite LLC. Profit after tax and minority interest stood at 15.5 crore in Q4 FY24, grew by 25% year-on-year basis. Coming to FY24 performance, sales volume for quarter stood at 5,64,294 units. Stainless steel sink stood at 1,27,489 units. Kitchen appliances, bath products, and others stood at 54,728 units in FY24. Consolidated total income stood at 688.1 crore for FY24 as compared to 593.9 crore in FY23. Grew by 15.9% year-on-year. EBITDA of the company for FY24 stood at 133.6 crore as compared to 108.9 crore in FY23. Growth is 22.7%. EBITDA margin for FY24 stood at 19.4%. This has little impacted because of increase in the freight cost due to Red Sea issues, but we are maintaining the guidance of 18-20% for the future. Profit after tax after minority interest stood at 57.9 crore in FY24 as compared to 52.4 crore in FY23, growth of 10.4%. Return on capital employed stood at 15.3% and return on equity is 17.3%. Thank you. Now I open the floor for question and answer. Over to the operator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of CA Garvit Goyal from Invest Analysis Advisory LLP. Please go ahead. Mr. Garvit, may I request you to please unmute your line and speak? Mr. Garvit? Due to no response from the current participant, we will move on to the next participant. The next question is from the line of Resha Mehta from Green Edge Wealth. Please go ahead.
Yeah, thank you. So the first question is on the domestic business. So if we see the India business revenue growth has been very soft, just 6%. And, despite all the efforts here, we hired a B2B team. We also consulted with Deloitte. So can you just talk about that? Why is the growth in India business in FY24 soft, and what is the growth ahead that we are expecting for India business?
Sure. I think it's not I think it's open fact that the India retail sales are soft overall, in spite of company making so much efforts. But I would also like to state that we have grown YOY, and we have a marginal growth over the past quarter. I believe that with the new initiatives by the government, and I think the heat wave getting over soon, and we're going to having a good monsoon, I believe that in the future quarters, the India market, the demand in India should improve. And also at the same time, company is focusing on high premium models to propel growth in India, which will bring further improvement in sales.
Okay. So any number that you would like to put for the India revenue for FY25 or FY26?
No, so I will continue my statement of growing in India on 15 to 20%, and I think we still maintain that for the coming quarters.
So because of the soft demand, do we see that our gallery ramp up or distributor expansion will also be kind of dialed down in this financial year?
I believe there is a huge opportunity. Yes, there is a softness in India, but I think there is also a scope for improvement. And I think the scope of improvement is quite huge in terms of value proposition. So company plans to add a lot of new value-added products, especially targeting the new premium and luxury segment. And I think that's where we think the most of the drive is going to come. Also, point 2 is we have taken 2 very large initiatives. One is we have now Mr. Rakesh Nair, who's now going to head the Sternhagen, which has been struggling for a while, especially we're not focusing on this. So now Sternhagen, the bathroom which will come into focus, and we expect good revenue growth from there. And second, the B2B vertical, which was absent till now, focusing on more on the builders, architects, interior designers. I think that has come into place. So that vertical so we have appointed B2B head Nikhila, which I mentioned in my statement. We already recruited 5 people already for Pan India. We plan to expand this team quite dramatically in the coming quarters. So I think with all the initiatives and in spite of the challenges of softness, we are very confident that in the coming quarters we will grow the market in India.
And my question on, the planned ramp up for galleries and distributors, would that continue or would we be dialing down on that for this financial year?
No, we will be continuing with that. We'll be continuing. Also, we are opening what we call the platinum stores. It's called the high-end stores. We call the experience centers. So we have already signed up three more, which would be coming in the next 2 quarters.
Okay. And what kind of revenue growth rates are we anticipating for FY25 for Carysil products and Carysil surfaces specifically, considering, as the UK market recovers?
No, so I think, it would be probably not right to give me this statement on this, but I think we would continue our guidance of, growth, which we have been, giving till now, about 15 to 20% growth year on year.
Okay. And also, if we look at the FY24 numbers, while our revenue has grown at 15%, our employee costs has grown by 34% and other operating costs by around 30%. So how much of this increase, is attributed to, let's say, the Red Sea issue or the United Granite integration? Can you quantify this?
May I request you to rejoin the queue for your follow-up question? Thank you. The next question is from the line of Kunal Ochiramani from Kitara Capital. Please go ahead.
So I want to know more about the fundraise you are doing. Where will be that deployed and the capacity?
Sorry, your voice not audible, sir.
Want to know more about the fundraise you are doing, the capacity going ahead, and the revenue guidance for the same for next 5 years.
So,
revenue guidance, I will take.
Kunal, on the fundraise side, we have already taken a resolution for up to 150 crore. We'll see at the appropriate time when we have to go for the fundraise. So this is the status as of now.
The capacity and the revenue.
So like organically, whatever required to be done, we are doing. But the fundraise part and the related capacity will come up once we finalize everything.
Okay. All right. Thank you.
Thank you. The next question is from the line of Tushar Sakhade from Kamakya Wealth Management Private Limited. Please go ahead.
Yeah, good afternoon, sir, and thank you for the opportunity. Sir, I have a few questions. Like in your own brand sales volume, what is your sales volume in that, and what kind of growth are you foreseeing?
So as far as India is 100% with our brand, total globally we are doing about 15 to 20% with our brand. And like I said, that we have taken all the initiatives to launch our own brand. We already started in Australia. We're doing it in UAE, Turkey, UK, and in the US. So our plan is that within the next 3 years' time, we would like to have our B2C, our own brand, at least about more than 30% globally. And India, we will continue with our 100% brand presence.
Fair enough, sir. Sir, you hit the all-time high volumes of 6.5 lakh, I think, in earlier years. So, what are your views on your volume growth going forward?
Yeah, thanks. Yeah. So I think, with all the initiatives which we have taken and all of the some of the new tie-ups which we have and some of the new tabs which are bound to happen, I think we are still sticking that we will be able to increase by 15 to 24% growth on the things. Yeah.
The volume growth you are saying, right?
Yes, volume growth, yes.
Fair enough, sir. So my last question. In terms of gross margin, we did really well in this quarter, but the margins are not, down towards the EBITDA. Just wanted to understand the reason for that.
Well, I think I think it is a mix of all. I think it is first I would like to say there is a great product mix. Our export to the US have improved considerably, where we have higher gross margins. Also on the operation side, we have our factories working on a high efficiency level. So I think with a mix of that, in spite of the freight cost, I think we're able to maintain our margin guidance. And your second question was?
Yes, sir. So the gross margin will be maintained, right, going forward as well?
Yeah, so we maintaining our 18 to 20% margin guidance.
Fair enough, sir. That was helpful. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please limit your questions to 2 per participant. The next question is from the line of Yug Patel from Eternal Capital. Please go ahead.
Good afternoon, sir. Firstly, congratulations for good set of numbers. So my first question is that I want to ask the sales breakup between UK and USA. If you could help me on that.
Yeah, so I can. I would probably maybe later on we can use the exact numbers. But I think right now, as you know, that out of the total 690 crores approximately, the UK sales is about 250 crores, which would come to about 30% of the revenue. And the North America market is about 30% of our sales in the total international. Out of the total, about 30%. Yeah. Thanks.
Okay. Thank you, sir. And my second question is that we know that the recent contract with Howden has been started and the orders have been coming. So I want to know that how the contract has been performing over the years and what will be the future for that.
So the deal with Howden's is the orders are flowing in more than what we have expected. We have to invest in new models to satisfy their demand, since also the UK market is improving. Second thing, our things are being accepted very, very well in the UK market. I think perhaps our models, quality, all the colors. But we have to, it's been anticipated that we would be doing much more than what we are expecting, and for this we'll have to expand our capacity in terms of molds to satisfy the Howden's demand. So, yeah, I think the deal is going very well.
That's it from my side. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Rohit Singh from Invest Analysis Advisory, LLP. Please go ahead.
Hello. Am I audible?
Yes, sir. May I request you to use your handset, please?
Yeah, I'm using handset only. Is it fine now?
Sir, your voice is very less. Can you come near to the mic and speak, please?
Now we cannot hear you at all.
Mr. Rohit? Mr. Rohit? Due to no response from the current participant, we will move on to the next participant. The next question is from the line of Srijana Mittal from Ratnatra Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. So I had 2 broad questions. So one is on the other expenses front. So you mentioned that other expenses is on the higher side because of the higher freight costs and some impact of United Granites integration. So can you quantify that for me, please?
Yeah. So other expenses are higher because of the freight cost. There is the integration of United Granites. There is some advertisement, promotional expenses which we have incurred. So these are 3 reasons for the higher other expenses.
Yeah, understood. So for the integration cost, can you quantify that for me? Like what would be the one-time portion, if any?
So one-time cost is already taken in the quarter 3. So there is nothing one-time. Now it's all operating cost.
Understood. So this would be a run rate number. And on the freight side, what would be the impact of the Red Sea? How much the freight cost, how much would it be higher by? If you can give some percentage
Yeah, so it's additional 1.5% is the cost.
Understood. Also, the second question is, for United Granites this quarter, how much was the revenue and what kind of margins could we get?
This quarter revenue is...
This quarter, I mean, you're talking quarter one?
Quarter 4. Quarter 4.
Quarter 4.
Revenue is 21 crore.
Okay, 21 crores. Okay, thank you.
Thank you. The next question is from the line of Harsh Shah from Dalal and Broacha. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions from my side. So firstly, could you kind of quantify what was the impact on the revenue due to the delays in delivery, which was because of the Red Sea issue? What was the number, if you could give?
Yeah. So my answer to that is, we had a delay of about 4 to 5 weeks because of this. I think that delay will have a slow effect. It's not any significant impact on us. But now on the quarter one, we will see what is the impact. But as of now, we have not seen any significant impact.
So there has been basically no delay in kind of revenue booking because of the delay. Am I correct?
No, there has not been any effect based on that.
Okay. Secondly, on the gross margins, this time around we did extremely well. So if I track back the numbers, so post FY18, this is the first quarter we had such good gross margin. So in terms of sustainability, in terms of while modeling, what should we consider the sustainable gross margin?
So I would say one thing. Our margin guidance will continue at 18 to 20%. There's one fundamental point, which is the fundamentals of the business overall is very strong for us, and especially the granite sink model. So once the point I'm trying to say is that we will be always addressing the premium segment of the market, and I think we're going to continue with that. And we would be adding a lot of new models which will be targeting more premium segments of the market. So we believe that the premium category will always grow, and I think we will stick to the margin guidance of 18 to 20%. Now, it is the same whether it's sinks or is the built-in appliances. So the company focus is more on driving growth for more on the premium and luxury segment of the market.
So, I get your point, but still it doesn't answer my question. If in terms of ballpark range also, if you could give on gross margin. So why I'm asking is that I think the earlier participant did ask about the gross margin. You said it's a mix of be it product mix or raw mat cost. I just wanted to understand what has led to such improvement in gross margins.
Yeah, so I'll tell you. One is the U.S. sales, like I said earlier, the U.S. sales has been significant in the last quarter, which gives us a higher gross margins. Second thing, our IKEA sales is up also in the last quarter, which is giving us higher gross margins. So, and third is our operational efficiency within the plant has improved tremendously. So I think with all these factors, there is not one single factor, but these are the three main factors which have resulted into the improvement of gross margins. Does that answer your question? No.
Yeah, mostly. So basically the raw material price has kind of remained stable.
Yes, the raw material have remained stable, and the rejection at the plant level, we have achieved an all-time low in the last quarter.
Got it. Okay. And lastly, on the working capital cycle, so when I look, so this year around, we have done the working capital cycle somewhere around 120 days. So I'm seeing that the inventory as well as the receivable days have gone up. So should we assume from next year onwards, we would be back to 90 days, or how are you looking at the working capital cycle? Because it has impacted the cash flow from operation to some extent.
Yeah, so I think it's two. I think this one thing is this two Red Sea, because of the Red Sea crisis, we have a lot of inventory which is probably for a short time. And second is because of the delays in the delivery side, the receivables have increased. So which is now back in order. Also, that's from the export side. On the India side, we have tremendously reduced our credit limits to our customers. So I think we are very confident in the coming quarters it will come back to 90 days.
Got it. And one last question. Anything on the repayment schedule? I mean, the debt, the short-term borrowings have gone up. So any kind of figure that you have in mind of what sort of repayment we would be doing in FY25 and FY26?
Yeah. So repayment is coming at 28 to 30 crore for the FY25 on consolidated basis.
On consolidated.
Yes.
So, okay, got it. Yeah, thank you. That's it.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please restrict your question to 2 per participant. The next question is from the line of Rohit Singh from Envis Analysis Advisory LLP. Please go ahead.
Hello.
Yes,
Hello.
Sir. Yes, sir.
I'm audible?
Yes, sir, you're audible.
Sir, my question is on guidance side. So earlier we were targeting on INR 1,000 CR kind of revenues in FY25, and now you are saying we are getting good order traction also in exports, and you are expecting the domestic market to also recover. So why we are reducing the guidance to 20% CAGR on the year going ahead from here? That's my first question.
So I think we are continuing our growth guidance for 20%. The 1,000 crore guidance which we had given in the past, I think we are also sticking to that. We have some inorganic opportunities we are exploring. So I think which when it realizes, which we are expecting in near future, I think that is going to happen. So I think based on that, I think we are still sticking to our 1,000 crore guidance.
So 1,000 crore guidance for FY25 is still there, right?
Yeah.
Okay. And on the domestic side, we have increased our distribution network significantly at the beginning of the year, but the result is still not there. Like we were earlier targeting 170 to 180 CR kind of revenue from domestic area in FY24, but we closed down to 140 CR. So are there any specific market challenges you are facing despite the existing demand, and what kind of strategies are you going to implement to capture the opportunities ahead and face the challenges?
You see, we have to honestly mold ourselves based on how market reacts. I think we are on track, but suddenly if the market in domestic gets sluggish, it gets softer, there is nothing much we can do. So I think there's a rethink in strategies that what new products we need to offer to address the premium segment of the market. What initiatives we need to do to launch new products which would satisfy the new target customer base. Also, third is what products we need to launch to cater to the B2B market. So I think with all this, we need to we have reset our strategy because we don't know till how long the market is going to remain soft. So I think the company has taken we have taken initiatives to see that we can grow at least 20% growth year on year for the coming year.
And sir, on the Red Sea issue, are you people really witnessing any kind of reduction in revenues? Like you mentioned from Q1, there may be reduction in revenues due to Red Sea impact. So how long do you see these kind of situations to prevail?
Sorry, I'm not with you on this. What was it? Sorry, your sound was very blurred.
I am asking on the Red Sea Red Sea issue due to this? Because you mentioned in a commentary also, like from Q1, there might be some impact in the revenue due to increase in the order delivery timeline. So how long do you expect this situation to continue in future?
See, the Red Sea crisis is not in our hands, unfortunately. It depends upon the geopolitical situation on this Gaza war and all, how long it's going to take. As far as our orders are concerned, I think, as I said, there's not any significant impact we see in the quarter one.
So fine, so that's so much. It's all the best.
Thank you. The next question is from the line of Khush Shah from Nivesh Investment. Please go ahead.
Hello, am I audible?
Yes, sir, you're audible.
So what would be your current capacity utilization?
So at the current capacity, we are approximately 70 to 75%.
70 to 70. So if we take a 70% utilization, so your current revenue is 684 crores. So if we take a capacity to 95%, so the revenue would be projected to 970 crores. So can you give some comment on utilization if you do a peak of 90?
Sorry to interrupt you, sir. May I request?
Please, we're not able to hear you.
Please use your handset.
Hello, am I audible?
Yes.
Yeah, much better.
Can you please repeat your question?
Yeah, sure. So your current capacity is around ballpark 70% and your revenue is projected, and your revenue is currently 684 crores. So if we do a current capacity projected to 95%, then your revenue in FY25 would be 970 crores. So can you comment on current utilization if we do a future growth?
No, so what you are talking is the consolidated sales. You're talking about a capacity utilization for just the granite sink. Now, granite sinks currently looking at an average by about 5,500. So going at a 95%, let's say ballpark 900,000 sinks. If you're looking at it, we're about 520, 530 crores.
Okay. Thank you.
Thank you. The next question is from the line of Sonali Bhaveshi from Value Investment Advisors. Please go ahead.
Hello, am I audible?
Yes, ma'am, you're audible.
So I need few data points if you can help me with. Can you just let me know the revenue from quartz sink only?
Only quartz sink.
For FY24. For FY24, yeah.
Yes. So quartz sink, we have revenue of 324 crore.
324 crores.
324 crore.
Right. And the steel sinks, in the presentation I see it's 11% of the total revenue, so that comes down to 75 crores. Am I right?
Sorry, I could not hear you.
Which is the revenue which has come down? What you said?
So in the presentation, I can see the revenue from steel sinks is about 11% of the total revenue. So that comes down to about 75 crores. Am I right?
No. Sorry. Which slide you are referring to?
So I'll just let you know 1 second.
Can you give me the slide number?
So the slide number is 32.
32?
Yes.
Hold on. So talking about 11% of the consolidated revenue, we had given the pie of the contribution. I don't know how we're getting 75 crore degrowth. It's not there.
So the contribution of stainless steel sinks to the consolidated revenue is 11.1%, right?
Yes. So earlier, you are comparing the FY23, it was 13%, now it's 11.1%, because the pie of the other products, which is surfaces, has gone up.
Okay. So, okay.
So it has not, there is an impact on the steel sink, it has actually grown.
Okay, so how much is the growth, sir?
So steel zinc growth is around 15%.
Okay. And Sir, can you help me with the realization number for quartz zinc and steel zinc?
Quartz zinc number,
it's about 5,500 approximately.
Okay.
Yeah, the stainless steel
is around 4,200.
Okay. Thank you so much, sir. That's it from my side. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please limit your question to 2 per participant. The next question is from the line of Risha Mehta from GreenEdge Wealth. Please go ahead.
Yeah, thank you for the follow-up. So, my question was on the Stern Hagen brand. So you did talk about expanding in US. So going forward, is this brand going to be largely a play in the US market, or it's majorly going to be India focused?
Which brand? Sorry, you're not audible. Can you repeat your question?
Yeah. Is it better? Are you able to hear me?
Yes, it's better.
Yeah. So, in your opening remarks, you said that the Stern Hagen brand would also be marketed in the US. So, is this brand going forward largely going to be a US-centric brand, or India play is also going to be, a focus area for this particular brand?
No. So it's both. So we are actually going to build a Stern Hagen as a global brand.
Okay. And the other question was on the, FY24 numbers. While this has been addressed in some form for Q4, but even if I largely look at the full year FY24 numbers, for a 15% revenue growth, our employee costs have grown by 34% and other operating costs by around 29%. So how much of this increase in employee costs and other operating expenses can be attributed, to the Red Sea issue and the United Granite integration?
Okay, so there is 2 things. One is this is the first year where we have integrated United Granite. So the cost is there, which is not comparable with the last year numbers. Okay, number 1.
What would that number be? The full year? What is the integration cost that we've incurred? Can you quantify that?
We can give you separately if you want. Okay. But the impact is because of, one is the integration. Second, we have built a team for the further capacity utilization, which was low in the last year. So based on that, we have built our team for the further growth in the current financial year. So there is a cost escalation because of these 2 reasons. And there is some hiring we did on the leadership team also.
Right. So going forward, fair to say that, the employee or the other operating costs, the increase there will be more or less in line with the revenue growth?
No, I mean, if we are looking at a volume-led growth in the coming quarters, it will going to be proportionately get absorbed.
Yes.
Right. And 18 to 20% margin guidance in any case stays, right? So.
Sorry, what margin guidance?
18 to 20% margin guidance in any case continues, right?
Yeah, it will continue. Yes.
And on the inventory front, post-COVID, we've seen a structural increase in the inventory days.
Sorry to interrupt you, ma'am. May I request you to rejoin the queue for your follow-up question? Thank you. The next question is from the line of Manan Mandani from Kamakya Wealth Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. I just want to have a volume number for the quad and SS things for India business of last 3 years.
So I have numbers for last 2 years, which I can provide you right now. So granite thing last year, FY22-23, 5,13,820. This year, 5,64,294. So volume grown by 10%. steel sink last year number of 1,08,507. This year 1,21,585. So the volume number grown by 12%.
Okay. And could you also provide an EBITDA split between all the products? Like what would be the contribution from all the products?
No, we are not making segment-wise reporting, so it's not possible for me to give you the breakup segment-wise right now.
Okay. So can you provide me the gross margin of the surface business particularly?
So gross margin for the granite sink is 48, on the ex-factory level, 48 to 50%. On the steel sink, it is around 35%, 30 to 35%. Appliances, around the 40%.
And the surface?
Sorry?
The surface business?
Sir, I'm not able to hear you.
Hello?
Faucet is around 45 to 50%.
Surface.
Surface gross margin around 26-27%.
Okay. So I just want to clarification on the growth for FY25. So the 15 to 20% growth is volume based or value based?
Volume and value both.
Okay. And the last question. So for this quarter, our other expenses on a consolidated basis have increased so much, and you also mentioned the reason behind it. So if we remove the impact of the higher freight cost, what would be the number of other expenses, if you could quantify?
So higher freight costs are approximately 1%. The Red Sea crisis. So
other impact will be around 1.5%. So total 2.5% is the impact.
Okay. So even if we remove the impact of the Red Sea crisis, our other expenses have increased, exponentially. So is there any reason, or is it sustainable, or is there any one-off in that?
I think we are very clearly given the guidance that 18 to 20% EBITDA margin guidance we are maintaining, considering all the factors prevailing as of date.
Okay. Yeah, fair enough. Thanks.
Thank you.
Thank you. The next question is from the line of Krishna Jeriwala, who is an individual investor. Please go ahead.
Good afternoon, sir. My question is related to kitchen appliance volume sold numbers, like why there is low or no growth compared to last year.
Yeah, so again, I think the market has behaved very softly, surprisingly. So that's the main reason for the built-in appliances.
Okay, sir.
Krishna, does that answer your question?
Yes.
Thank you. The next question is from the line of Tushar Ragade from Kamakya Wealth Management Private Limited. Please go ahead.
Yeah, thank you for the follow-up question. I just wanted to know, like in domestic, you doubled your distribution, but in tandem, the revenue has not grown. I understand there are some challenges, but what would be your focus going forward? So what are your plans for the domestic business?
So like I said, we are going to address the premium market segment. So we plan to launch high-end built-in appliances like TFT control models, which will be the first time in India, and which are user-friendly models, and we would be targeting at good price. So I think there are a lot of initiatives like this. We are also launching a range of built-in refrigerators of different model sizes, which is going to add to the revenue growth. So this kind of lifestyle products we plan to launch within the next four months' time. And so that's one. And on the kitchen sink side, we are going to plan to launch more bigger bowl sinks. Right now, our fastest selling models are 2418, 2118. We plan to launch models like 2818, 3018, which will be used as a workstation and which will fetch a much higher value per piece value guys. So these are the two initiatives. And the third one is the faucet factories on. We are already assembling about 2,500 to 3,000 faucets now, currently a month. And I think which is gaining traction very fast in India. So I think we also see faucets as one of the major growth drivers for the Indian market.
So you mean the JVT faucet, that colored one?
Sorry, what is that? Come again?
You mean the JVT faucets, the metallic color faucets?
Yeah, so we are going to do stainless steel faucets which are lead free, where you can drink water directly through your in your kitchen. So there is no lead. And second is the gunmetal, PVD, we are adding a range of these kind of colored faucets to the range. So which is going to add
hello?
Yes.
Yeah. So my last question, what would be your contribution from the Southern India?
Southern India right now is about 27% of the total India domestic sales.
Okay. So like in company level, where are you focusing more in terms of when you consider India as a whole?
Where we are focusing is that your question?
Yeah. So which part of our country is your focus area going forward?
Yeah. So I think, one, we have identified in our gap analysis study that one of the states which we are not very focusing is, that is Hyderabad, Telangana area. So I think we are stepping up rapidly our activities around that state. Also, we are targeting now more tier 2 and tier 3 cities where we think the growth opportunities are very large. So that's what the focus is going to be within the coming quarters.
Fair enough. So that was helpful. Thank you.
Thank you. The next question is from the line of Meet Raj from Anubhuti Advisors. Please go ahead.
Yeah, thanks for the opportunity. Am I audible?
Yeah.
Yes, sir.
Yeah. Sir, I want to better understand your FY25 growth target. So basically, we are at 684 crores in FY24, and the contribution from United Granites in last 2 quarters was 36 crores. So without that, we ended at 650 crores. So for FY25, if we grow at 20% for our main business, then it will touch at 780 crores. And if United Granites contribute 80 crores for next year, so we will end up being at 860 crores. So I'm just trying to understand, do you have any plans for big acquisition if we want to have 1,000 crore revenue in FY25?
So I again repeat that we are looking at inorganic opportunity as a right time. If you see any fit, which is a strategic fit for the company, we will go for it.
Okay. So without, let's say, if we don't do any acquisition in FY25, then we might end up at 860, 870 crores in FY25.
Yeah.
Okay. Thanks a lot. Thanks.
Thank you. The next question is from the line of Aditya from MSA Capital Partners. Please go ahead.
Hello.
Yes, sir, you're audible.
Hi, thank you so much. So just wanted to know what is the split between the FTL revenues and UGL revenues for FY24?
Sorry, can you repeat the question again?
So just wanted to know what is the split between Silmar Tech revenues, the Carysil Services revenues, and the revenues from United Granites.
Okay, so Silmar and the Carysil Services is the same. Revenue coming from the Carysil Services is around 150 crore, and around 31 crore we got from the United Granites.
Got it. And sir, is there any gross margin improvement that you witnessed in this quarter from United Granites?
We have already discussed on the gross margin side. Okay.
He's talking about United Granite. I think with any initiatives, what we're doing, the residential sales going up, which is a high margin sales, yes, there will be an improvement in the United Granite margin.
And plus, now that we've started sourcing our materials from India, so that would even act as a better margin improvement plug, right?
Yes, for the coming quarters, yes. Yeah.
So if you can quantify what is the current gross margin run rate for United Granites and where do you expect it to go in the next 2 years?
I think the last quarter rate was about 42%.
All right. And next 2 years?
I think there will be a margin improvement. I would not want to tell you at this point of time, but yes, there will be margin improvement based on higher residential sales and better gross margin product mix.
Perfect. Thank you so much.
Thank you. The next question is from the line of M.N. Kumar, who is an individual investor. Please go ahead.
Thank you for an opportunity to asking this question. Sir, this issue has been addressed already. But the sales, if you look at the standalone sales, the increase is around 36 crores, but the receivables are almost 80% of it. I hope this is going to get resolved rather quickly, is one point which I would like to do. The same thing is at a consolidated level also. So I hope it is going to get resolved very quickly. That's only the point I just wanted.
Sorry, can you repeat your question? We are not able to hear you clearly.
Sir, standalone sales increase is around 36 crores per year on year, right?
Okay, yeah.
But trade receivables, if you look at it, they are almost 80% of it.
No. It's not 80% of it. I think your numbers are not correct. The numbers what is given here is separate for the standalone and the console. It's not 80%.
Yeah. So can you go to the slide, the standalone balance sheet?
Standalone balance sheet, yeah.
And the trade receivables have gone up from 55 to 83.
Yes. Okay.
So that's around 27 crores, right?
Yeah, 27 crores. Yes.
And if you look at the top line change, that goes from yearly 335 to 371.
Oh, got your point. But see, you are looking the number as a balance sheet. This is the annual number, and you are comparing with the quarter on quarter. That's not the right.
No, I'm not comparing. I'm talking about yearly itself. I'm talking about. I look at a yearly P&L and yearly balance sheet, right?
Correct. So number of days has gone up. It's already explained that because of the delay in the transit in the export market,
so there will be improvement.
There will be improvement going forward, and this is only because of the delay in transit what is happening with the Red Sea issues. Fundamentally, there is no change in the receivable days, and it will be back to the normal.
Yeah. In one of the other questions, you did indicate saying that Red Sea issue is behind us. It is not made much of a difference. That was also point. So I'm struggling to understand what exactly is the reason, because the top line change and not getting locked up in the trade receivable is not a very comfortable thing. I hope this issue gets resolved quickly. That's only the point I'm making.
Definitely, this will be resolved. It's a temporary issue which everybody is facing, and we are also not, isolated from that. But it's a temporary issue. Nothing, anything we have to worry on that side. Thank you.
The second one is also the inventory. Is there any specific reason why the inventories have gone up at consolidated level substantially? Is there any other explanation?
So, see, this is the first year of integration of the United Granites. So the receivable and inventory both are added. That's why it's not comparable with the previous year numbers.
Okay. Understood. Thank you.
Thank you so much.
Thank you. Ladies and gentlemen, due to time constraint, we will take that as the last question. I would now like to hand the conference over to the management for closing comments.
Thank you, everyone. I hope we've been able to answer all your questions satisfactorily. However, if you need further clarification or want to know more about the company, please feel free to get in touch with the SGA team, our investor relations advisors. Thank you. Have a great day. Go ahead.
On behalf of Carysil Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.